Ladies and gentlemen, good day and welcome to Sterling Tools Limited Q4 and FY23 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Group CFO, Mr. Pankaj Gupta. Thank you, and over to you, sir.
Good morning. Thank you. Good morning, everyone. On behalf of STL Group, I extend a very warm welcome to all of you for our Quarter 4 and FY23 earnings call. I am joined on this call by Mr. Atul Agarwal, our whole-time director, Mr. Jaideep Wadhwa, director, and SGA, our investor relation advisors. We have uploaded our results presentation on the exchanges, and I hope everyone had a chance to get it. I will now request Mr. Atul Agarwal for his opening remarks.
Good morning, everybody. Good to connect with you guys after almost a 3 to 4 month gap. Let me just start with a brief overview of the industry. Firstly, India surpasses Japan to become the third largest auto market globally, with a revenue of $222 billion and anticipated to reach $300 billion by 2026. Two-wheelers and passenger cars dominate the market, accounting for about 76% and 17.4% of the market share. Passenger vehicles grew. We had a dramatic year. It grew by 25% this year. FY23 as compared to 19% in FY22. So I think numbers have been phenomenal. Improvement is largely driven by growth in utility vehicles, lowering of age group of buyers who prefer innovation, high safety, and technology. The PV industry segment is expected to grow by about 5 to 7% in FY24, and hopefully this will be on the back of improvement in supply chain conditions for semiconductor products. Commercial vehicle industry grew 29% in FY23. It was supported by increased activity in road construction, mining, improved infrastructure, and a lot of spending by the central and state governments on improving the e-commerce sector. Commercial vehicle segment is expected to sustain a growth momentum with scrappage policy likely to drive fleet replacement and encourage new truck purchases. The two-wheeler segment grew at a rate of 9% as compared to a degrowth of 3% in FY22. We have witnessed growth, but production is still below pre-COVID levels. The two-wheeler volumes are expected to rise within a range of low to single mid-digit in FY24, with steady improvement in rural economy on increasing MSPs for key crops. Premium bikes are expected to maintain growth momentum, while exports might continue to be affected in the near term due to macroeconomic issues. Coming to business overview. The company forayed into EV component business with manufacturing motor control units. Currently, the EV space is a sunrise sector, and we firmly believe that it will be the next big thing in the Indian automobile industry. The overall EV sales crossed 1 million mark in FY23, and EV two-wheeler segment grew at a rapid pace. New launches in the EV two-wheeler expected to pick up, and penetration is expected to improve significantly. Scooters will become a dominant form of two-wheelers. Amidst all this, OEMs need to strictly adhere to safety regulations. We foresee multiple tailwinds in the EV space that will enable STL Group to maintain its leadership positions, coupled with a path towards achieving sustainable profitability in the future. Our revenue from EV component business grew by 3.5x from last year. This business secures more than 15 contracts, and now we have initiated capacity expansion from 300,000 units to 500,000 units per annum. revenue from EV component business increased to 171 crores in FY23 compared to 38 crores in FY22. We are optimistic about our growth plan, and we will continue to work towards achieving our vision to become a pioneer in the green energy space. Now I'm going to request Pankaj to take over and run through the financial highlights with you.
Thank you, sir. I'll now give you the financial highlights for quarter 4 and for financial year 2023. Starting with the standalone numbers for quarter 4 of FY23 at a standalone level, total income from 140 crores in quarter 4 FY22 to 159 crores. This is a growth of 14% YOY. EBITDA increased by 14% to rupees 21 crores versus 19 crores. EBITDA margin was at 13.3% in quarter 4 FY23. PBT stood at 8 crore with a margin of 5.1%. This was impacted due to exceptional items pertaining to liability of 3.29 crores we recognized on the foreclosure of our EPCG license. If the said exceptional item were not there, the PBT margin was 7% level. PAT stood at 5.3 crore. FY23 complete year on a standalone level, the total income grew by 27% to 604 crores in FY23, up from rupees 475 crores last year. EBITDA increased to 92 crores FY23 versus 73 crore, which is about 26% growth in the EBITDA. PBT and PAT grew by 43% and 39% respectively to reach to 57 crores and 41 crores in FY23. Coming to the consolidated financials, equally good year or better. Quarter 4, we had total income increase from 170 crores in quarter 4 to 203 crores, which is 25% increase in the quarter. EBITDA increased by 30% to 23 crores, which is 18 crores previous YOY. EBITDA margin increased from 10.6% in quarter 4 to 11% in FY23. PBT increased by 10%, is 10 crore in quarter 4. PBT margins were at 4.7%. That increased by 13% YOY to 8 crores over 7 crores. The full year on a control level, total income increased from 513 crores, all-time high number of 775 crores, which is about 51% growth in the total revenue of the group. EBITDA has increased by 44%, and we have touched 100 crore EBITDA absolute number first time in the history in FY23. It was 70 crore last year. PBT also surged by 82% and at a 63 crore level, up from 35 crore last year. And the margin also increased to 8.2%. That increased by 87% to 48 crores in FY23 over 25 crores in FY22. That margin also improved from 5% to 6.2% in FY23. Thank you very much. We may now begin with question and answer session. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Deepan Sankara Narayanan from Trustline PMS. Please go ahead.
Good morning, everyone, and thanks a lot for the opportunity. So firstly, from my side, so what will be the impact on FY24 EV volume sold with this EV subsidy controversy of government and the pending investigation on these players? So what kind of impact we are expecting? And also, what is the impact on our customers? And is there a possibility of Ola gaining more market share from current levels?
Okay. Good morning.
Guys, I'm going to hand this over question to Jaideep. Jaideep is the director on Sterling Tools. He's also the managing director of our EV business.
Okay. Good morning, everyone. I think the first question that you asked was, is Ola going to be able to gain more market share? I don't think we are the right people to answer that. Those are questions that would be best asked from Ola and the other OEs. We think it's a great company. They've got a lot of new product offerings in the pipeline, and they have very ambitious plans and a lot of capacity and a lot of drive. But how it actually pans out in the market, I think I would leave that to the OEs to decide. Regarding the FAME subsidy, people expect that the FAME subsidy at the current run rate could run out sometime by the end of October or November this year. The expectation is that maybe the government will extend it till the end of March. What we understand from most of our customers is that they are working very hard to offset some of the losses if the FAME subsidy is not extended further, and these are again decisions for the government to take. But if the subsidy is not extended further, I believe the OEs their strategy will be around cost optimization to a large extent, and there are some tailwinds there that will help them. For instance, there is excess capacity for batteries in China right now, especially in the formats that are currently used in two-wheelers. As compared to, say, a year ago when a company like Ola was air freighting batteries from China, you have a current position today where the cell manufacturers in China are willing to lock in prices for the next 2 to 3 years because of excess capacity that is available with them. So I think that's going to give our customers and the industry some benefit. They're also working very hard on cost optimization. Volumes are helping, and there may be still even after all these optimizations, there may be a price increase that the customers may have to pass on to customers to maintain similar levels of margin. We believe, as do our customers, that now that the young customers, the early adopters, have seen the benefits of the EV, have seen the riding experience, have experienced all the user interfaces that EVs offer, the trend will continue. I think the government subsidy has done its job in that it's made EVs very popular. And now it's not only, I think people understand the benefits of the electric vehicles, and if we can continue to make the total cost of ownership attractive, which I believe the industry will be able to do, the industry will continue to grow even without a subsidy if the subsidy is withdrawn.
Okay, understood. So what will be our revenue growth outlook for this EV business for next year? So where will this growth driver coming from for us?
Yeah.
Which is only from this first customer, or we are extending our volumes to the second or third customer? So that understanding will be helpful.
So I think we've discussed this earlier, that we have 15 customers who have given us confirmed contracts. Now, volumes on these customers fluctuate a little bit because of various reasons. Again, you have to understand the EV industry is nascent. In the recent months, a lot of volumes have been impacted because of the fact that the government changed the battery standards. And most companies, really had to scramble to comply with them. But as this is now all being settled, we expect that these customers that have given us orders, which is across two-wheelers, three-wheelers cargo, three-wheelers passengers, and LCVs, we will see volumes go across. Now, I do believe that the growth potential for our business is at least 2x from where we are today.
Okay. And one more question on the EV side. So we have seen a sharp jump in gross margin for EV business. So is that due to product mix changing or some RM price cut which has helped this quarter?
So if you look at the overall EBITDA margin, that hasn't changed much. So there's also a bit of, in the way we were reporting earlier, we were reporting a lot of the job work that we were doing in cost of sales. We've now restated that into other expenses, so I think that's made a difference. So you'll see that most of the jump in the gross margin, as you see, is a lot of it is offset by an increase in other expenses. So net, the difference, there is not much difference between the 2 quarters, and the margins as they are stable. We continue to work on further cost optimization, but it's not something that is going to give us a very big jump, from quarter to quarter. It's something that will be incremental and continue to work.
Okay. So lastly, from my side, what is the reason for sharp increase in this consolidated other expenses to 64 crores?
So I think I'll let Pankaj answer the question of the sharp increase in consolidated other expenses. Obviously, there is some contribution in that from SGM because of the factors that I just explained, but Pankaj will go into greater detail.
Yeah, so I think Jaideep answered console increase in other expenses on account of EV vertical only. So nothing on the standalone, no change over there.
Thank you, sir. Ladies and gentlemen, in order to ensure that the management will be able to answer questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Abhishek from Dolat Capital. Please go ahead.
Good morning, sir, and thanks for the opportunity. So, a few questions from the partner business. So, there is a sharp fall in the margin in partner business. Is it because of the old inventory, or there are the other constraints, like that jump in the power cost and other things?
Yeah. Good morning, Abhishek. Let me take this point. So, we're talking about the quarter 4, right?
Yeah. Okay.
So, quarter 4 has one-timers. So, there was the whole year with a 600 crore turnover. There's annual volume discounts which we pass on to the customers. That has been provided in this time, and some year-end provisions also we have made. And the steel prices came down as a part of which the inventory evaluation impact is there. So there is no concerning item on the margin drop in quarter 4. We continue to, on a yearly basis, if you see there is hardly any change. We are pretty stable. And these are one-timers in the quarter 4 which has pulled the margin down.
So, given the lower steel prices scenario, your margin is always between 17 to 18% kind of the number in partner business. This time it has gone down to 11%, and as you are mentioning, there are some inventory adjustment and other provisions. So, if we normalize all these things, what would be your margin in the first quarter FY24?
Just to correct the data, so it's not dropped to 11 ever. Anyway, we can discuss that offline. But yes, our margin of EBITDA around 15.5%, which is the yearly average, is where we are today. And we think that's the number to consider.
Okay, sir.
So if I can add to that, firstly, I don't know where the number of 11% EBITDA has come in from. I think there may be some communication gap, so you can take it up with us offline and run the numbers with you. Secondly, to add on to what Pankaj said on Q4 numbers, let me just say, yes, it's down percentage or 2 points vis-a-vis Q3. And Pankaj explained what those one-time issues were, but I would rather focus on the full year EBITDA margins, which are still healthy, despite the fact there's a numerator-denominator effect, inflationary issues on the balance sheet in FY23. Now, having said that, steel has softened. Steel has softened, but that does not mean steel has softened, giving us dramatic savings. But the trend is on the lower side. There has been a marginal reduction in steel buying prices, but it's not dramatic enough to make a substantial margin impact for next year. Having said that, if I can just spend 10 seconds on next year, we believe our margin structure for FY24 will be better than FY23 on a full year basis. Quarter on quarter, we have issues on inventory valuation depending on RM or other inflationary issues. But on a full year basis, I think our guidance will be that margins improve over FY23.
So, sir, what is your margin guidance in the revenue and margin guidance for FY24, sir?
For fastener business?
Yes, sir, fastener business.
So I think we are at 15% plus right now. I think we'll be close to 16% or so.
16%. And top line growth, sir? I mean revenue growth?
So we are looking at, for top line growth, let me just I want to dive into a lot more data before I get into guidance. Let me just say that the industry going forward, like I said in my opening remarks, PV industry is expected to grow at 5% on a more aggressive side, but that's our estimates, but most indications by CM or other industry bodies are looking at about 2 to 3% industry growth in PV segment. Farm equipment is expected to be flat, and two-wheeler industry is up maybe 9%, but that's also changing the mix. What's happening there? Two-wheelers also not expected to grow to anything more than about 5% or so this year. So keeping in mind industry growth, I think we are looking at growing anywhere between 17 to 20% for next year.
So how was the mix for the fastener revenue in terms of the two-wheelers, passenger vehicles, CVs, and farm
Say that again, please.
How was the mix for the fastener revenue in terms of the two-wheelers, passenger vehicles, CVs, and farm equipment in FY23, sir?
So, okay, have the numbers in industry segment ratio.
Industry segment.
Give us a second.
Yes.
So I think just to give you a sense, while Pankaj is opening the data for himself, we are at in FY23, we are at about 20% in two-wheelers. In passenger vehicles, we are about 24-25%. Commercial vehicles, we are at a similar number. Farm equipment is at about 11%, and aftermarket is at about 14-15%. Just to give you a sense where we are. So I want to, dive into another data point out here, which is I didn't mention that the commercial vehicle industry grew 29%. But our revenue in the commercial vehicle segment has gone up by 62%. Two-wheeler industry grew 9% last year. We have grown 36%. Farm and tractor equipment has grown 12% last year. We are up 36%. Passenger vehicles are up 25% last year. We are up 35%. Overall, we are up 28% in revenue terms over last financial year. I just wanted to put that data out there that Sterling has grown faster than the industry in all segments of the business. And I think that's why we have grown for 28% in revenue terms in FY23 over FY22.
Great, sir. And what is the volume growth, sir?
Excuse me, sir. I would request you to kindly rejoin the queue, sir. There are many other participants who are waiting for their turn.
Okay, I come in.
I request you to. Yes, sir, please. Thank you. The next question is from the line of Sonal Gupta from HSBC Mutual Fund. Please go ahead.
Hi, good morning, and thanks for taking my question. So just coming back to the margin side, right, like a couple of quarters back, you guided that the fastener business margins would be in the range of 16 to 19%. And I would imagine that these annual volume discounts are like seems like an annual practice, so this should have already been worked into your estimates. So just trying to, and now you're talking about 16% EBITDA margin, which is the lower end of your guidance. So just trying to understand what has changed here in terms of your cost structure, etc. And like you just mentioned, I mean, like you are gaining market share, you're outperforming the industry in all segments. So just trying to understand like why a sort of downgrade on the margin expectation.
So a good question, Sonam, but let me just say, yes, our guidance is always between 16 and 19%. We are giving a guidance of about 60% for FY24. But I want to your question of a past guidance. Now, there are 2-3 big factors. One is a mathematical issue. Steel has gone up by roughly about 24,000 rupees a metric ton, which is almost 35% from the base prices. Now, just because of that mathematical numerator-denominator effect, we have got full compensation from our customers for steel price moving up. But just because of the mathematics, the way it plays out, the margin structures fall. For example, on a low base of steel, our margins were about 18% plus. If we keep a similar cost structure and the steel goes up, there's a numerator-denominator effect of about 2.5-3% on that. So that's causing additional pressure mathematically more than anything else. Second part of the equation which gets impacted is because of inflationary cost pressures, where costs have gone up on other inputs, would be chemicals, energy, people, etc., etc. In FY23, we were working with a lot of customers to give us price increases. Those price increases were a long time for negotiation. We've been able to conclude a lot of the price increases with our customers, which are kicking in either in 1st April this year or which have kicked in just a couple of months ago without giving us a full year impact. So I think that those price increases on account of inflation cost increases on top of steel price increases are going to kick in for this full financial year. Now, having said that, I would still give a guidance of 16%. Once the steel prices soften more, I think this can go up to 17-18% from a more normal range. But from the current indications we have, steel prices are not expected to soften so much to give us that benefit. Thirdly, what I would say is that this year the industry is only expected to grow in the commercial vehicle segment only. We don't see much growth coming in other areas. And having said that, we are still giving a guidance of 17-18% revenue growth this financial year. So the numbers what you're hearing from me on 16%, I would not say it's a change in guidance. I would still say it's very much in line of 16 to 19%. And if that steel softens a bit, then numerator-denominator effect will automatically bump it up to 17-18%. If you like, and I'll tell Pankaj to set up a separate call with you just to explain to you how that equation works.
Yeah, great. Thanks a lot, Atulji. So the second question I had was on the sequentially, if I look at the which is the EV business essentially consolidated, revenues have also been flattish. So it seems to indicate that the EV revenues have been also sequentially flattish, despite the fact that we've seen clearly some of, one of your largest customer having a significantly increased sort of shipment, etc. So just trying to understand that why have we not seen a benefit in terms of revenues?
Okay, so we've grown between quarter 4 22 and quarter 4 23. We've grown 83%.
I was talking Q3 to Q4.
I know that. Now, if you look at, I know that one of our large customers has grown in the low double digits between quarter 3 and quarter 4. Okay, but you have to, and we continue to have 100% share. There is a difference. I mean, what is inverted what is inverted by the customer, what their stocks were, there is some level of fluctuation that takes place. Okay. So all that we are seeing there is that we had the stocks at the beginning of the third quarter at our customers' place was significantly higher than the stocks at our customers at the end of the fourth quarter for a number of reasons. Both customer and us are trying to get back up to a higher level. So you will see that we will possibly have higher shipments to them in this quarter than they will have to their end customers. But I think quarter over quarter there will be, there are some changes that take place, and there are a number of factors for this. But there is, we continue to be 100% of the business, and it's just like I said, a factor of their inventory movements and the way their productions have panned out versus how our productions have panned out.
Got it. And if just on this, the last question I had was, when do you see the three-wheelers and LCVs sort of customers, the orders that you won sort of ramping up? When do you see the launches happening?
So three-wheelers have already started moving up fairly well. I think, and I think we've had a good quarter in the fourth quarter. LCVs we don't see volumes really picking up, till probably the third quarter of this year. Right? What we are selling is in tens and low hundreds. It's not in the thousands.
Got it. Great. Thanks a lot. I'll join back with you. Thank you.
Thank you.
Thank you. The next question is from the line of Manish Ostwal from Nirmal Bang. Please go ahead.
Yes, sir. Thank you for the opportunity. And I have only one question because most of the questions already answered by the management team. So for the quarter 3 to quarter 4, the rise in the other expenses, what is the component of one-off in that rise of incremental numbers?
You're talking of EV console level or standalone?
I'm talking of consolidated other expenses line items, sir.
Sorry, just can you repeat? You are talking of standalone or console?
So I'm talking about consolidated financials, sir, and I'm talking about other expenses movement from quarter 3 numbers to quarter 4 numbers. So there is a substantial increase. So what is the one-off component in that?
So if you see the published results, I think other expenses this time is including power and fuel and consumption of store and spares. That's the presentation part. I hope you have factored that in.
Yeah.
Besides that, as Jaideep just mentioned, in the EV business, there is expenses relating to which costs has come down and other expenses have gone up. So the nature of those expenses is like job work, selling and distribution expenses, labor cost, and general administration expenses, because there's a ramp up in SGM. So these expenses are falling in other expenses, and that is the reason it is going up. But we should also see that the proportion overall, there is no impact.
Well, you were talking on the one-off cost. What is there any quantification of the number, sir? One-off cost and other expenses.
The details which are available, and it will broadly as a item, these are heads which I mentioned.
Okay, sir. Thank you.
Just for your better understanding, as I said, it has job work, selling, distribution, labor cost, and general administration expense.
Yeah. I better understand you clubbed the many expenses this quarter. Better understand that. But if you take the operating margin movement from the quarter 3 to quarter 4, there is a substantial drop. So that is
see the year as a total will be a better picture, and as I said, because of the volume increase in the electric vehicle segment, these expenses in absolute term will go high.
Sure, sir. Thank you. Thanks a lot. Thank you.
Thank you. The next question is from the line of Viraj from Simple. Please go ahead.
Yeah, hi. Am I audible?
Sir, your voice is a little bit muffled. I would request you to use your handset, please.
Hello?
Yes, sir. Please continue.
Yeah, just a couple of questions. First is on the fastener business. You talked about outperformance for us in FY23. versus various end segments. So is that value outperformance, or you're talking in terms of volume? Growth?
Let me take that up, Atul here.
Hi, sir.
We are up 28% in revenue, FY23 in our fastener business. 21% has come through volume growth. 7-8% has come through a combination of price increases and product mix improvement. That's just to give you an overall company data point. Secondly, the values which I've shown increase, they're substantial increases. For example, I mentioned commercial vehicle is up 29% as an industry segment. We are up 62%. So these outgrowing each segment is substantially on account of volume increase we have been able to achieve because of new product development which kicked in, new negotiations we did for our customers for share of business changes, etc., etc. So we are up across all the 4 segments in the automotive industry because of the same reasons.
Okay, and when you say 17 to 20% growth in FY24, despite the industry being muted, that's at the fastener business level, or you're talking more at the consolidated level?
So I'm talking on the fastener business level.
Okay, so again, that will be largely volume growth driven, right, sir?
That will be largely driven through a combination of new product development, share of business changes in our favor from customers.
So if you can just provide a little more granularity in terms of, various end segments, what will our share be now with major customers? How has that changed in the last 1 or 2 years? So, that will be very helpful.
So just to give you a sense, let's talk about, if I talk about two-wheeler segment to start with, there our share of business has marginally improved, or we have been able to maintain with the largest customer, which is Honda Motors and Scooters. We were able to acquire a lot of new business at Suzuki Motorcycles, which is part of Suzuki Group. I think that business went up almost 50% for us over last year. That gave us a huge bump in our business. If you look at in the passenger vehicle space, we were up 35%. We've been able to grow marginally again with our main customer Maruti Suzuki, but we were able to grow substantially in Mahindra and Mahindra's automotive division. We had done a lot of product development work with Mahindra over the years, which translated into substantial volume and value increase in this financial year. As we all know, Mahindra has done very well in this automotive division. So I think those are 2 reasons. In farm equipment, we were always a strong player with Mahindra. We have grown dramatically in Mahindra tractor division, and we had acquired John Deere as a customer 2-3 years ago. Those values for new product development kicked in FY23, which will improve in FY24. So those are the 2 big reasons where it went up. Plus, we did business. Our business with off-highway with JCB has also gone up dramatically. We are up almost 100% with JCB, again on the back of new product development and work we have done in the last 2-3 years. In commercial vehicles, industry is up 29%. We were up 62%. Growth came on the back of Leyland, where we have done a lot of new product development in the last 2-3 years, where the values have gone up. I think we are up with Leyland almost 100% over last financial year. We are up about 35% in Tata Motors, and we are up about 40-odd% in Volvo trucks as well. So, in summary terms, all I can say is a lot of new product development work done in the last 2-3 years that has kicked in. Plus, because I think we were able to work with the customers to improve our share of business across board.
So just to kind of go a little deeper on this, and just 2 parts of this. One is, as you said, it takes a couple of years for the new product development and to kick in and to materialize. So based on the efforts which we are making in the last 2-3 years, even if the industry volume were to remain subdued, or even in that environment, do we have enough pipeline in place which can keep us sustain this growth rate, say not just in 24, maybe even in FY25? And a related question is also in the sense in terms of margin. So when we kind of bid for these new projects which we are looking to commercialize, inherently, I mean, in the past also we have been very conscious in terms of the the profitability in the products which we bid for. So in that sense, there's no change in those margin thresholds which we traditionally looked at before, when we look to bid for new products.
So let me answer your first part. Yes, you're right. It takes 2 to 3 years for a new product to translate to value. The guidance we have given for FY24 on revenue growth is, despite the fact the industry is not growing, and going forward for FY25-26, we are already working on product lines where we have visibility as to what is going to kick in terms of value and bump up revenue for us. So I think we'll share with you as we go forward in the year. Some stuff I can't share with you right now because of competitive reasons, but I can only show you that our revenue growth plans for FY25 and FY26 is also robust, keeping in mind the activities we have going on. On your second part of the question, just refresh me again, was on, can you refresh the second part of it? Yeah, so on the margin. So yes, as a company philosophy, we believe in that margin retention is very critical in what we are trying to do. So our philosophy remains the same. We are not compromising margin structures to find this growth. We are looking at more and more critical part development. Will help us not only in margin retention, also improve our competitive position with our customers.
Okay, that's good to hear. Can I just squeeze in one more question? On the EV part.
Please, sir, I'm sorry to interrupt, sir. I would request you to kindly wait for follow-up questions, please.
Sure. Thank you.
Thank you, sir. The next question is from the line of Alisha Mahavla from Envision Capital. Please go ahead.
Hi, sir. Good morning. Thank you for taking my question. So my first question is that we're talking of 17-18% growth on the fastener side. That means we'll be anywhere between 700 to 750, which I believe is the peak revenue we can do. So do we have any incremental capex plans on the fastener side?
So I think we're investing 30 odd crores incremental capex this year. I don't have the exact number, but guidance will be between 25 and 30 crores. So yes, we are adding incremental capacity for certain specific products and certain balancing equipment. So that's an ongoing capex. That's an ongoing capex we are doing, which will supplement capacities. But I think our revenue, we had given a guidance of, some time back of maybe, I think about 800 crores. We are not given a revenue guidance of 750 on a full basis. My sense, if I remember correctly, is more like 800 crores. And this may be before we had price increases kick in. So this number may be north of 800 as well, including the capex we are doing this year, and going forward we will do incrementally to support the growth of the business.
So just to clarify, this 800 crores is including the 30 crore capex that we're planning to do this year?
No. I think 800 crore capex is based on the old numbers. The 30 crore capex is on top of that, and which will help us increase our capability to grow beyond 800 and do certain other products which are not currently, our equipment is not currently capable of manufacturing.
Understood. On the fastener side, we said that apart from the annual volume discount, we also had some amount of inventory loss because of reduction in steel prices. Is it possible to quantify what is the inventory loss for the quarter?
No, I don't. I think Pankaj, I don't know if you guys can correct me, but my sense on the inventory loss is not an inventory loss. It's more of a valuation exercise loss. Pankaj, you want to explain that? I don't know, you want to take it over?
Yeah. So basically, whenever there are steel prices changes, it gets reflected in your closing inventory, and we sit with the large inventory. The valuation change is what is captured in quarter 4. So there's no loss per se on inventory. It is a valuation which is having an impact. And these are timing differences. As you move forward, prices change. Again, these things will keep reflecting in the results.
Is it possible to quantify this amount?
I think it's a bundle along with right now I don't have number to share with you. Maybe we can connect offline to this.
So if I can add on top of what Pankaj is saying, these are valuation exercises which are done quarter to quarter. So that if you will find some quarters the cost of inventory goes down, some quarters goes up, depending on the buying practice we have done in the last quarter or the quarter before that, because there's a large pipeline of inventory at finished goods level. There's an inventory at our work in progress level, which is revalued quarter on quarter depending on the buying prices and cost of production for that quarter. Yes. Yeah. So yes, the quarter. At times the quarter may look bad. At times the quarter may look very good. So what we trying to do as business owners here in the business is we like to focus on the annual numbers, which are more representative of the true nature of the numbers.
So while I understand that it will be different from quarter to quarter basis and it makes sense to look at the annual number, just trying to understand if this is start of a new trend with reduction in steel prices, where the margins can be. My last question is on the consolidated side, we've done about 10.5% kind of margins. And for partners, we've said that we're looking at doing 16% lower end of our band for 24. On Concall, what is the kind of sustainable margins we can do?
So for the quarter, yes, if you see the blended for the complete year on a console is around 13% EBITDA margin, right? So as we advise on a faster business, margin should be in the range of around 16. And for the EV business, we currently are at a 6.5% EBITDA margin for the last year, and 6.5 to 7. And our as we move to the next year, our advisory earlier was also in the range of 8 to 10%. So there is going to be about 2 to 3% improvement in margin in EV, about 1% of margin in fasteners. Blended, whatever comes will be an outcome of that. So it will definitely be better than 13%.
So I think also if you look at the mathematics in the last quarter, the EV business did a revenue of roughly close to 60 crores, which is almost 30% of the revenue of fastener business. In a fastener business, we did 150 crores, and 33%, and EV did close to 60. So about 35% revenue as a percentage came from the EV business. Now, that automatically, mathematically, the ratios change, and that puts pressure on the consolidated margin structures. And having said that, these margins are expected to go up. I just want to mention, since you're talking about margin structures, we got to keep in mind the two separate businesses, fastener business and EV business. I think one data point we need to address would be return on capital employed. And I think the return on capital employed in the EV business is dramatically better, despite the lower margin structures in that business. That ROCE there in that business is about 35% in FY23. So I think we need to factor in we need to keep an eye on ROCE as well as margin structures while looking at the business overall.
Okay, great. Thank you.
Thank you.
Thank you.
Thank you. A reminder to all the participants, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Chirag Setalvat from HDFC Mutual Fund. Please go ahead.
Yeah, hi, good morning. Just a clarification on the growth numbers. So on one hand, you mentioned growth of 17 to 20% in fasteners, and then subsequently there was a number of 800 crores. And if I get this right, your fasteners revenue is roughly about 600 odd crores in FY23. So if you could help clarify that.
No, so I think the question by one of the members on this call was 800 is what the number they're understanding on a full capacity basis. It was not for FY24.
Okay, so that's on full capacity you can do 800 crores.
800 plus. Like I said, we are doing incremental capex this financial year. So the guidance on a full capacity will be 800 plus, much north of 800.
Sure. So the guidance is for this year is for this 600 odd crore revenue business to grow by 17 to 20%.
Correct.
Right. The second is on the EV business. Can you help explain the competitive advantages that the company has? Because my extremely limited understanding, I'm not sure how value added this product is. How much is, what is the sort of value add the company is doing, and how easy or difficult is it for competition to enter into this area?
Okay, so obviously, let me first start by just explaining, and I hope I'm not being too repetitive for all the members on the call. the motor control unit, is a factor. And I'm talking, and the architecture differs from different for different vehicles and different vehicle classes. But let's just talk about a high-speed scooter because that's where the bulk of the market is right now. In a high-speed scooter, the motor control unit basically interfaces with the battery pack and the BMS there. It interfaces with the vehicle control unit. It drives the motor and it interfaces through the vehicle control unit with the instrument cluster. So the most important part of every part of a vehicle is important because without everything coming together, it doesn't work. But the motor control unit has a large software component to it, both which drives the performance and efficiency of the controller, but also the overall vehicle performance. So and that's a differentiator in some ways. And that's why we've also talked about the fact that there is a lot of stickiness because while it is possible to replace a controller, there's a lot of software work that is required to do so. Because of all the interfaces that are there with different aspects of it. In terms of the value add, and what is our competitive advantage, we understand, with the 3 years since we started this company and 5 years since we've been working on this project, we understand the competitive landscape. We understand, the vehicle architectures very, very well. We understand what is required to get the vehicle to do what our customer, which is the OE, wants it to do, and our ability to provide that engineering support to the customers and to get the vehicle to where they want it to be, I think is a key factor, and there's a lot of experience that's been built in. We've developed an ecosystem of suppliers to allow us to ramp up to the volumes. We've gone up pretty much from a standing start to 180,000 units and more, and we're continuing to expand. We've locked in suppliers for DSPs, MOSFETs, and other key components. So we built an ecosystem that enables us to be able to cater to our customer requirements. So at the end of it, we've got the engineering edge out there, and we've got the supply chain and the ecosystem in place. So yes, there will be competition. Competition will increase, no doubt about that. But we will, I think we are well placed to be able to maintain our competitive advantage in this space.
And where do you see revenue? Last question from my side. Where do you see revenue in the EV business this year?
I mentioned earlier that we are looking to at least double.
And this year was 170 crores, right?
Yeah.
Great. Thank you very much.
Thank you. The next question is from the line of Chirag Shah from White Pine Investments. Please go ahead.
Yeah, thanks for the opportunity. Sir, I have first a few housekeeping questions or other clarifications. So one, when I see your presentation, you include other income in your EBITDA calculation. Is it possible to indicate what exactly it is? Because when I look at the annual report, a large part of this appears to be treasury income, fixed deposit, interest, and all those kind of things. So that is first question, because if we exclude other income, then the pressure on margins seems to be slightly higher, either annual or quarterly. So that is one. That is the first housekeeping question.
So yeah, other income is interest on treasury, scrap sale, and this time we had about 2.5 crore of dividend we received from Haryana Ispat, our subsidiary company. So this is not a substantial amount. In terms of percentage margin, yes, you can compute with revenue from operation basis than total income. In fact, the margins will improve if you do that. The denominator is going to reduce, right?
Okay. The second question is, you indicated that there was some mark-to-market valuation negative impact on inventory. So in the past, is it that we also had a positive impact on quarterly basis because when steel prices were going up?
Yeah, that is true because that is how the steel behaves, and that of course there have been benefit in the past too.
So as a request, sir, if it's possible, if you can highlight that in presentation, whether a gain or a loss, it will help us to understand the quarterly numbers also reasonably better. And the last question, if I can, this is more on the product side. So on the fastener side, you indicated that there have been market share gains. For example, in Ashok Leyland, you indicated, in M&M, you indicated because of product development. Can you indicate what these products were? What kind of products were you referring to?
So same fastener, if you look at any vehicle for that matter, there are about 300 different kind of part numbers, SKUs which go into making a vehicle. So we have not developed, or no other fastener maker has developed the entire range of 300 fasteners. So that development activity is an ongoing one, but we try and focus on more critical parts to do that. I think that has given us customers are already buying that from competition, or maybe it is for a new product or a new model they were launching to replace an old model. It's a combination of those things.
Okay, so what I was referring to is, are these more engine-related fasteners or chassis-related fasteners, if you can indicate, or are they very different in terms of the thickness or the fine-tuning that you do? Are they far more that you are not making? So what exactly are these? And going ahead, what kind of development you are making without going into the strategic information which you can't share?
Yeah, so these developments are more for transmission and for engine application.
For transmission engine applications. And we assume that this process will continue. It was not a one-off thing, right? So,
no, it's an ongoing process. That's how we are able to do what we do. It's an ongoing process.
And I'm referring to the pace. I was referring to the pace, the way we have scaled over the last 2 years in terms of market share, and I'm referring to volume market share in general. I'm more referring to that perspective. So that process continues.
Process continues, and in fact, our objective is to intensify that more and more going forward.
And does that have a negative rebound on your margins in the initial phase, in say year one or something like that?
Can you repeat that question?
So the new SKUs that you introduce with the customer, does it have a negative impact on margins in year one when you introduce them? So suppose you introduce a new SKU or a new fastener, say with M&M, just as an example. Will it have a negative impact?
No, the margin structures don't get impacted on account of that. The only thing when the volumes are being ramped up and the first year volume is slow is that the changeovers we need to do on our cold forging machines go up. But that's a marginal thing, That is not really margin. It does not impact our margin structures in any meaningful way.
Okay. Thank you very much. I'll come back for more questions.
Thank you. The next question is from the line of Rohan Samant from Multi-Act PMS. Please go ahead.
Yeah, thank you. This is Rahul Picha from Multi-Act. Again, coming back to the standalone P&L, so sequentially we see an increase of raw material cost from 42.8% to 47.5%. As you have explained, it seems that this increase is largely led by the inventory revaluation exercise that we have done. So firstly, wanted to understand that, is this understanding right, that it's largely led by the inventory revaluation? And secondly, the revaluation exercise is done on a quarterly basis, or we do it every year in Q4? That is my question.
I think firstly, if I can correct you, Pankaj, you can back me up on that. Our raw material content has gone up from 40% to 42.15% on a Sterling standalone basis, Sterling Fastener standalone basis.
Okay.
So I don't know what number you're referring to, but that's what for the fastener business is currently at 42.15%, up from 40%.
Okay, the numbers that I have seems to suggest that it's gone up from 42.8 to 47.5. Maybe I'll clarify it offline.
Oh, but I think you're looking at only from a Q3, Q4 perspective. You're looking at Q3 FY23 and to Q4 FY23. I think that's what you're looking at.
Right. Correct.
It's gone up from 43 to 46.5, 42.63 to 46.45.
Okay.
But on a full year basis, it's gone up from 40% to 42.15%.
Okay. So this is largely due to the inventory evaluation that has been done?
No, see, and there are two factors. The inventory valuation is a very small part of the total year, if you see 2%. The denominator impact, which we keep mentioning our call, please understand, Rahul, whenever the steel prices will go up, my percentage margins are bound to drop, and vice versa. And unfortunately, we have not come across price reduction on a permanent basis on steel in last at least 2.5 years to 3 years. So there is a downward trajectory of the margin in percentage term. So as you were mentioning, about 24 rupee a kg has been an increase in last 2.5 years on steel. So this really kills the percentage margin. However, we get our price increases, and in absolute term we are intact, and that is why we are able to maintain our EBITDA margin and all.
Yeah. So Pankaj ji, actually my question was more from the movement that has happened from Q3 to Q4. So just wanted to understand that this inventory revaluation that you do, is it done every year in Q4 or is it done every quarter? Because the impact in Q4 seems to be material, and this was the same in last year as well. So that is why I'm asking.
Sarun, you want to take that? I don't take that.
So actually, there are two components in it, okay. First one, the margin impact that Pankaj sir already told, it is very nominal. Second one is that the inventory gap. If you see, our inventory has gone down. So what has happened because of reduction in inventory, my RM content is going up. I hope I am able to clarify you.
It's a change in closing stock. We can maybe discuss in offline in detail. Yeah.
Okay.
Thank you. We have the next question from the line of Tanya Gupta from G Portfolio. Please go ahead.
Hello, good morning everyone. Thank you for the opportunity. I just want to understand, I was going through the PPT where the product mix for the EV segment, the three-wheelers and LCV stood at 11% each. I just want to understand whom we are supplying in the three-wheelers and LCV space. And subsequent to that, are these products, are these orders, are they in prototype nature, commercial scale orders? And what is the potential for this mix and how can we grow if we took for the long-term span, maybe FY28, FY29, it's very long term. So how are we targeting in terms of product mix and EBITDA margins from these, particularly three-wheelers and LCV segments? This is my first question.
Okay. So the three-wheeler and LCV segments, though relatively small right now, are very important because these are segments that we see a very good penetration of electrification. This is where the TCO has been proven, or at least in the case of three-wheelers, is proven to be very favorable, and in the case of LCVs too, it is expected to be very favorable. So there are many expectations that a gasoline-powered three-wheeler will become a part of history sooner rather than later, and what you'll really have is either CNG or electric. So the potential is very good. Yeah, there has been, we've got business from, I guess, the leading companies in this space. I'm going to just take a minute to talk to my team here to figure out if I can share the names.
Sure.
So we are in production with companies like Euler, which is one of the leading companies in India, and we have contracts from companies like Mahindra. So there is, if you look at that space, we have business across the spectrum, and there are a number of other smaller companies. Yeah. Are we online? Is there? Yeah. Okay. So I said we've got business from established three-wheelers, and as well as from we call as startups. In the LCV space, except for, I rather than giving out names, what I'll say is that except for Tata Motors, with whom we continue to work, every single LCV manufacturer has given us a contract for at least one of their models. So it's just a matter of the models coming into the market and for their sales to ramp up, and you'll see our sales ramping up also.
All right. If I could ask the content in the product, is that increasing? I mean, how we are seeing the content in the product that we are supplying to three-wheelers and LCV part. And what about the product mix? Since, currently there's 98% two-wheelers and, 1% which is very minuscule. So if we took a long term, are you looking for a balanced approach in this EV segment?
So, I think the way to answer that, first of all, I'm not sure what you mean by content. Could you explain that to me, please?
Since, you have mentioned for fasteners that we are doing, and other players are, doing 300 fasteners, the product segment that we have in the fasteners. We are supplying almost 300 and no other players are there. So are we looking, with the same perspective for the EV part, the product that we have created, the MCU part, are we increasing the content so that we can, have, higher wallet share from the suppliers?
Okay, so there is only one MCU, unless typically there is one MCU per vehicle. I won't get into vehicle architecture here, but you can take that as a standard, and that's what we and therefore we can't increase the content with MCUs alone. But as we have stated in earlier calls, it is the intent of the company to look for other parts of the EV powertrain, so that we become a more significant partner to our customers. So yes, expansion of the portfolio is definitely a part of our strategy, but it's not that the MCUs will become a bigger part of the. Now, if I can just take a minute, and looking at what we did, what happened in last year, the total sales of EV was 1.18 million. Right, EV sales were 1.18 million, of which 63% was electric two-wheel. Now, e-buses was 0.06. Electric three-wheeler cargos or three-wheeler cargo was 4%. Cars 4%. Now, passenger vehicles is 28%, but I have to say that that's not a pure number because that has some e-rickshaws in it. So our share of business from two-wheelers is not, in some ways, it's not identical, but what's happening in the industry. Yes, we would definitely like to have a greater, participation from other segments, but that's as these segments grow.
All right, understood.
Question?
Your voice was breaking actually. I couldn't hear the last statement.
So what I said was that as of today, electric the electric three-wheelers are 4% of the total EV market. LCVs are non-existent in electric vehicles today. Therefore, and 68% is from electric scooters. So therefore, while we have our share of electric scooters is higher, what I would say is that it in some ways our sales pattern mirrors what's happening in the industry. As the industry matures and electric three-wheelers, LCVs, etc., as they become a bigger part of the overall electric vehicle sales in India, you will see that our sales will also grow.
Sure, understood. And second question from my side is...
I'm sorry to interrupt, ma'am. I would request you to kindly rejoin the queue, ma'am. There are many other participants who are waiting for their turn.
Sure, I'll join the queue.
Thank you, ma'am.
Thank you.
Thank you. We have the next question from the line of Sonal Gupta from HSBC Mutual Fund. Please go ahead.
Hi, thanks for taking my follow-up. Just one question, like what Atulji mentioned, in terms of we seem to have grown faster than the industry in all segments by a substantial margin. And I think, like you mentioned, CV 62, two-wheelers also. I mean, everything is about 20% or more like 30%, but our overall growth is 27, 28%, and like you mentioned, 21% of that is volume. So price and mix has also been a positive contributor. So just trying to understand, like, what's the missing thing, right? Like, if everything's growing closer to 30 or higher, then why is the overall 27, 28?
So, good question, Saurabh. I think the missing piece here where we are underperforming would be our export segment. I think that has degrown for us substantially. I think if Arun, what was the number in FY21 exports?
47 crores.
Yeah, so we have degrown in our export segments. I think that value was 40 crores plus in FY22. It's close to a range of 10, 12 crores. So we've lost, I think, or rather we would say, I won't use the word lost some customers. There has been a shift of buying philosophy, some of the customers we were working with. So I think that's the missing thing. That's domestically we have grown dramatically as you've seen the numbers, but we lost a growth opportunity, or in fact we did for that export segment.
Got it. Great. That was my question. Thank you so much.
Thank you.
Thank you. The next question is from the line of Abhishek from Dolat Capital. Please go ahead.
Sir, how much revenue growth in the two-wheeler segment in partner business, sir, in FY23?
In FY23, one second. Yes. So in the two-wheeler segment, we have 36%.
So PBs is the 25%, CVs 62%, two-wheeler 36%, and farm equipment is also 36%.
That's right.
And export, but earlier it used to be the 2-3%. Export used to be 2-3%. So is it the indirect export or direct export?
No. I think in FY22, our exports almost were about 45 crore to 10% of our revenue. I'm talking about specifically FY22. In FY23, we have done 11 crores. So there has been a growth, you can say about 35 odd crores we lost in export segment in FY23.
Okay, sir. And my last question is on in the two-wheeler MCU segment. So you have, as the Simple Energy has started production, how much share of business do you have, and how much it will boost your revenue in the MCU segment?
We have 100% share of business.
What is the target revenue or the volume from the first quarter FY24 in from Simple Energy?
I think we should. Look, they've given us some forecast, but I think that's a question you should ask Simple Energy.
Yes, sir.
We have 100% share of business.
Okay, sir.
Okay. Thank you. Thanks. Michelle, since we're running tight on time, I just want to make a couple of more comments on, as follow-up to our last few investor calls we've had. Just for the entire participants today, that one of the concerns raised by the investor community was our contingent liability in terms of EPCG obligations. Now, we have addressed that dramatically this year in FY23. Our obligations are down by almost 70% for FY going forward. That's why if you see our as an extra line item before the line, we have taken a provision of about 3 odd crores as EPCG obligation monies we have paid to the authorities. We were able to mitigate obligations, availing some government schemes by paying. At the same time, we had to pay some penalties to do that. We have taken a proactive effort to reduce our obligations and minimizing dramatically the contingent liability on EPCG going forward.
So as we shared last time, very good progress on EPCG side. You will see in our annual report, and in next 3 to 4 months' time, this entire obligation on account of EPCG, which has been a concern, we will stand cleared on that. So this is from my side.
On a second thing, I think I think few meetings back we had already for commercial paper on from the board. We are not going to activate that product at all. At that time, commercial paper looked attractive vis-a-vis our current borrowing. Currently, we are borrowing short-term money at about 7.5%, or maybe going up to 7%. But obligations for commercial paper and the tightness in scheduling for that, we will not be activating that. I just want to put it on record. We will not be activating vehicle product at all. So just to give you a sense, these two areas where, from an investor perspective, there was a potential contingent issues on cost, etc., and risks. We have on one EPCG we have reduced that. On the commercial paper side, we are dropping it completely. Last just announcement. Give you a sense as to what we are doing in our EV business. Motor control unit business specifically. I would address that. We have spent our engineering spend last year was close to a couple of crores on engineering. Forward, this engineering spend is going to go up to between 6 and 7 crores. We are upping the investment on engineering spend both in terms of engineering headcounts, capabilities, and also in terms of testing, validation, competence as well. So we are increasing our engineering spend by 3x more. Just to say that we want to strengthen that business. We want to maintain the head start we have with the competition. We want to maintain the advantage we have as a first mover, and use doing more and more investment going forward. We have also opened a Bangalore Tech Center where engineering will reside, not only to upgrade the current product lines, also build new product lines going forward. Lastly, we will be, I think one of the questions which came off on the spend per vehicle, will be strengthening our EV product portfolio beyond motor control units. Some things are in the pipeline, but my apologies, I will not be able to tell you more details of that. Hopefully, we'll have some more announcements in the near future telling you what we are trying to do in that. These are the things I wanted to update you guys as to what's happening.
Thank you very much, sir. So can we close the call now?
I'm good. We are good.
Thank you very much, sir.
Thank you everyone for joining the call, and I hope we were able to address all the queries you had. In case of any further clarification, please reach out to us or to us. We'll be happy to support you. Thank you very much.
Thank you, sir.
Thank you.
Thank you. On behalf of Sterling Tools Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.